Good afternoon. This is Tony Cherniawski, manager of the Practical Investor, LLC. Today is January the 26th, 2010, and the topic for this broadcast is the 2010 forecast for the Standard & Poor's Index. The burning question is this a chain reaction accident waiting to happen? This video is meant for instruction and entertainment purposes only. This is not a solicitation to buy or sell any security. A purchase or sale of a security may result in a loss of principal. Please consult with an expert advisor who may explain the risks of any investment you may consider. You cannot invest directly in an index. Hello, 911. I'd like to report a potential accident. Yeah, I said potential accident. Oh. Well, it's out on the freeway. You know that dangerous curve there? It's got ice now, and traffic is pretty heavy. Yeah, we're going to have a chain reaction sooner or later. Can you send somebody out there to get these guys to slow down? Well, what? Oh, okay. Well, sorry to bother you, but it sure makes a lot more sense to prevent accidents from happening than to come back out and clean up the mess afterwards. All right, you have a good one. Don't say I didn't warn you. Well, what I'd like to do is just report to you that there is a potential chain reaction accident waiting to happen in the Standard & Poor's Index. And I'd like to just go to that right now and give you the rundown of how this might work out. The first thing is, on the hourly charts, we've got a broken wedge formation. A broken wedge formation by itself is pretty bearish. And I'll get into the true bearish implications of that in a little while. But at the moment, Tom Bulkowski at the Encyclopedia of Chart Patterns suggests that the average decline out of the broken wedge is about 19%. That takes us down to pretty close to 925 on the S&P. Well, as of Friday, it stopped at 1090. And a lot of people are saying, well, okay, that's it for this correction. Upward and onward it goes. But the answer is no. The likelihood is much stronger that we'll break the support at 1090. Now, what's significant about that support is that it's a trend line of a broadening top formation. Broadening top formations are also very bearish. In fact, they have a 96% probability of following through to the downside. So once this thing breaks, we have a good chance to see the Standard & Poor's Index go all the way down to about 825, and this, my friends, is where things start to get interesting. Well, let's take this a step further and go to the daily chart for a minute, because you can see at 825 we have another broadening top formation that's been hanging with us since last June and July. So there, my friends, is the next potential breakdown. And so it's suggested that there may be a bounce off 825, and that bounce has a strong likelihood of not succeeding and taking us all the way back to the top again. So once 825 is violated to the downside, there is another 23% decline probability ahead of us with a target of about 635. By the way, that's lower than the 666 that we saw last March. So in other words, this chain of events happening here in the Standard & Poor's Index give us a high probability that not only will last year's low be retested, but potentially violated as well. Let's take this one step further, and we'll go to a weekly chart. Now, the question being asked is, can't the Standard & Poor's Index go higher? And what we have here in the weekly chart is the neckline of the giant head and shoulders pattern that caused the decline. Once it was violated, it predicted the decline all the way down to 741. In fact, the target, by the way, was 724 for the Standard & Poor's Index, with the neckline at about 1204 at that point. Very interestingly, we stopped at 741, so we didn't quite get all the way, but we went even further in the next decline occurring in March. Now, what this suggests here is that the Standard & Poor's number 1 is done going up. We don't have the ability, in my opinion, to better that resistance that we have overhead at about 1180. Now, granted, the S&P topped out at 1150. Could it go higher? Yes, but now that we've broken the downside of the wedge, and you can see this on the weekly chart as well, the chances of that happening are very, very slim. Now, let me go back to the wedge for a minute, because Bulkowski reported that the average decline in the wedge is 19%. But others, including John Murphy, have reported that the wedge can completely be retraced. In other words, not just the July low, but all the way down to the March low can be completely retraced once the wedge is broken. So what that gives us is a scenario here. The big picture is that the wedge can be retraced, but if we go back and look, what we can find here is the stair-step chances of how it's going to roll out for us over the next several months. My target right now for the ultimate low of this decline is late April. My suggestion is that this next decline, the very next one down to about 825, could happen in the month of February. We'll see a bounce off the lower trend line at 825, and then the final decline into late April as a distinct potential for how this is going to play out. So what I'd like to do is just invite any of you viewing this to please take necessary precautions. And if you would like to follow the progress of this decline over the next several months, you can become a subscriber at the Inner Circle newsletter. You can reach me to inquire about it at tonyc@thepracticalinvestor.com. That is my email. Or you can go directly to my website, www.thepracticalinvestor.com, and there is a form to contact us as well. So in any event, I hope you trade carefully, trade well, have a happy new year and a successful one at that with your investments. And in the meantime, please do the right thing.